This is Macro Horizons, episode 315, Powell's Pronounced Patience, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of March 17th. And with all the uncertainties currently at play, the outcome of March 18th and 19th could potentially be pivotal. After all, it's the first four of March Madness. Powell who? Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, we had data, we had supply, but we also had the price action itself and the evolution of Trump's trade war. As the equity market continues to drift lower, the bigger concern becomes at what point does that ultimately shift into the realm of being a monetary policy event? As it currently stands, there's nothing to suggest that Powell should lean dovishly, given the relatively pedestrian correction. However, another 7, 8, 10% lower in the S&P, and the narrative will surely shift. The logic being that financial conditions will be tightened to an extent that to keep policy effectively where it was at the beginning of the year, the Fed will need to restart the process of normalization. The upcoming Fed meeting is very topical, and as we consider the SEP and the dot plot, a upward revision of, let's call it 0.2% to the core PCE projection for 2025 is our base case scenario. And while we don't see any real urgency on the part of the Fed to change the 50 basis points worth of rate cuts for this year being signaled via the dot plot, if there is a shift, we'd assume that they err on the side of signaling 75 basis points rather than the 50. It goes without saying that the market is seeking greater clarity on the Fed's response function to the trade war and what this all might mean for the Fed's willingness to normalize rates further. Our concern is that come Wednesday, the Fed won't have enough clarity to provide the market with the insight that it's seeking, and instead, the chair will simply express that the committee is in no hurry to cut rates, and the ultimate impact of the trade war remains unknown at this point. Again, this wouldn't be a particularly satisfying response for the Treasury market and markets more broadly, and we'd expect that the takeaway from such a tone would be to focus on trading the dot plot and anything contained within the Q&A. Taking a step back, to some extent, the Fed is surely content to see some of the loftier valuations come out of the equity market, if for no other reason than the implications for forward inflation expectations. The bigger concern is that some initial signs of equity wobbles turn into a more durable correction, and that has fallout for consumer sentiment, which when combined with the softer footing that already existed in the consumption profile, as evidenced by real personal spending in January, leads to a material leg lower in the pace of spending, and on top of the drag from net exports in Q1, puts us into a negative real GDP growth scenario at a time when global markets were generally expecting the U.S. expansion to continue. If nothing else, the week just past illustrated how quickly and dramatically the macro narrative can change. If nothing else, interesting times.
Well, we now have February's core CPI report, and that was, frankly, probably going to be the biggest event of the week, regardless of what happened on the tariff front. And what we saw was a fairly pedestrian increase in core consumer prices last month. Core CPI came in at 0.2% month over month versus the 0.3% consensus, and on an unrounded basis, a gain of just 0.227 helped calm some of the more severe concerns about the potential for a reflationary acceleration, and at least on the margin, moderated the risk that right as the growth outlook begins dimming, we're starting to see inflation tick back higher. Now, the most interesting aspect of CPI, I would argue, was not contained within the actual details of the report, but rather the market's response, which was in the immediate knee-jerk, a move toward lower yields in response to the lower-than-expected number, but then we saw rates start to climb, which yielded, no pun intended, no shortage of client questions looking for an explanation for the move, which at this point lies somewhere between maybe an economic disaster is not right around the corner, and a positional argument given all the buying that took place in the rally that got 10-year yields as low as 4.10. But nonetheless, 10s remain comfortably within their wider, lower trading range that we've seen established as the market shifts to a wait-and-see stance both for the next headline out of Washington, but also next week's FOMC meeting.
I have a slightly different take on the market's reaction to core CPI. On the margin, it was a below consensus print at 0.227 on an unrounded basis. In fact, it's the second lowest on an unrounded basis print in the last 7 months. However, when translating that through to core PCE, it looks like we're going to be in for a middle-of-the-road 0.3 that could round up into a 0.4. So I think that part of the reversal of the knee-jerk was the market taking a harder look at the details of the core CPI numbers and concluding that while we might be seeing a partial reversal of the one-off upside surprise in January, the reality is that there'll be upward pressure on the 3 and 6 month annualized rate of the Fed's favorite core inflation measure, which is core PCE. Another observation that I'll make is that even immediately ahead of the CPI release, the market was trading more off of forward inflation expectations based on the trade war. So almost regardless of how the core inflation number printed, we would have expected a resumption of the upward pressure on yields based largely on the latest uptick in tariff-related headlines, as we recently learned that Europe has introduced retaliatory tariffs on U.S. goods.
And in some ways, it's interesting to see almost a mirror image dynamic of what we got last month, which, remember, was a stronger look at CPI, but on a compositional basis, not quite as dire for PCE. And so in keeping with what this means for the Fed and what's been a clear unwillingness to overreact to a single month's worth of data, we had a softer core PCE print last month, one that's maybe going to be a little bit firmer this month, all while the underlying angst on the state of the labor market persists with the added benefit, or not, of the tariff uncertainty between the U.S. and Europe, between the U.S. and Canada and Mexico, and other countries around the world that continues to be traded from the growth negative side of the equation. Now, we'd be remiss in a discussion of what the market has done this week without acknowledging the pressure that we've seen in risk assets, with the S&P 500 well off the highs, the NASDAQ having already entered a technical correction. This all begs the question, is the tariff story and what's becoming a fairly quickly dimming growth outlook materializing enough in risk assets, with what that means for financial conditions, that we're going to see a more dovish tilt from the FOMC next week, and the potential for the dot plot to show 75 basis points of cuts over the balance of this year? Especially after the input of the latest inflation data, there is no shortage of factors for the FOMC to consider in evaluating the type of forward guidance messaging they want to deliver, given that rates will almost certainly be staying unchanged next week.
And to your point, Ben, there's a lot of uncertainty associated with the FOMC decision and the beloved dot plot. All else being equal, it makes sense for the Fed to hold the 50 basis points worth of rate cuts that they've already signaled. Because if Powell is going to stick to the narrative that they don't yet have enough information on the trade war to appropriately adjust forward monetary policy expectations, then why would they add back in another rate cut or two? Now, that being said, given the composition of the dot plot itself, I think the risk is that it does signal 75 basis points worth of cutting if we don't get the 50, which is our base case. It's very difficult to envision that they would signal only 25 basis points in 2025. Also within the SEP, the Fed's probably going to increase the core PCE estimate for 2025. So with that nuance from the Fed's perspective, it would be difficult to increase your inflation assumption while simultaneously dropping your policy rate projections. Perhaps the more tradable developments will come from the press conference. I'll argue that one of the biggest questions in the market at the moment is which put is struck higher, the Trump put or the Powell put in the equity market. Said differently, it's reasonable to expect that if equities continue to sell off at the pace and in the magnitude that we have seen recently, that either Trump will shift some of the trade war rhetoric to be less adversarial and less dogmatic in his push against globalization, or Powell will pivot. And I think that's what makes the press conference far more interesting, because while we're not expecting any material change in the statement, and certainly not a rate cut, the chair could introduce the rising risk of a prolonged slowdown, if not an outright recession.
And that's a big reason why even during late January and early February, when, remember, there were some in the market expecting no more cuts at all, or even the potential for a rate hike to be the next policy move, that Powell and the rest of the committee have retained their easing bias and not really given any airtime at all to the idea that perhaps the cutting cycle is over, and continually reiterating that they still view monetary policy as restrictive, and while the finish line of this particular normalization cycle doesn't necessarily need to be the lower bound, it will continue to be appropriate to bring rates closer to neutral. It's a version of the fine-tuning cutting campaign we saw in 2019, where 3 rate cuts were then followed by a period on hold that ultimately resolved to be a moot point once the pandemic struck. But in this particular economic episode, the Fed certainly has ample capacity not to overreact on the dovish side, given the softening but still strong labor market, while still being ready to act, given that the forward distribution of risks around the path of the economy are still probably skewed toward the downside. And while, especially after the move toward lower yields we've seen over the past few weeks, that doesn't preclude periods of bearishness in treasuries and moves toward higher yields, it will likely keep the demand that we've seen bring rates to these levels intact, especially considering the global rates backdrop and a cut from the Bank of Canada, an ongoing easing bias from the ECB, and all that means for the relative attractiveness of U.S. 10-year yields that are still comfortably above 4% when the rest of the world's fixed income return is not nearly that attractive.
And I think that you make a very good point about how the U.S. stacks up against the rest of the comparable investable alternatives. The one caveat is the bond market. Given what's going on with the potential for more issuance as Germany, and to a lesser extent Europe more broadly, invests in infrastructure and defense, we've seen a market increase in longer-dated rates in Germany, and again, to a lesser extent, France. And we are sympathetic to the argument that there is the potential for some substitution effect as investors choose to diversify their fixed income holdings. After all, the strength of the dollar has faded, and as the global trade war unfolds, the question of the dollar's standing as the world's reserve currency will obviously remain relevant.
And finally, to wrap up the conversation around the Fed, let us not forget what the minutes of the January meeting showed in terms of the Fed's thinking on the balance sheet and the groundwork being laid for a slowing or stopping of QT. Now, all else equal, it would be in keeping with the Fed's prior behavior to follow through on that decision, given the fact that they chose to lay the groundwork for it in the last minute's release. So in addition to the language of the policy statement, we'll be keeping an eye on the implementation notes of next week's release to see if the committee feels they've made enough progress in shrinking SOMA to slow or stop the process. And if not a decision that is delivered in March, we certainly expect by the end of Q2 that we will have reached the point when the balance sheet will have stopped shrinking. Now, this is in no small part a function of the fact that extraordinary measures have been enacted, the TGA continues to be run down, and that makes it challenging to truly interpret the state of the funding market at this stage, given the excess liquidity that's being injected into the system from the Treasury Department. And so in thinking about the underlying rationale for the Fed's decision to deliver that communication in the minutes and potentially stop QT next week, we're certainly on board with the thinking of better safe than sorry as it relates to making sure the funding market remains orderly given all the other uncertainty that's out there in the market at the moment.
One way or another, it will be the end of QT as we know it.
and we feel fine.
Put the fun back in funding. In the week ahead, the primary event will be Wednesday's FOMC decision and Powell's press conference. Let us not forget, we also get the updated SEP as well as the dot plot. As far as the rate goes, we are anticipating no change from the Fed. The Fed has done a good job in signaling that they're content to keep rates on hold for the foreseeable future, and the biggest debate in the market at the moment is how long is that foreseeable future. We remain in the camp that anticipates we still get 50 basis points worth of rate cuts this year, but that comes in the form of 25 basis points in September and 25 basis points in December. This progress towards further normalization would bring the upper bound to 4% and position the Fed well for 2026. But all of this is predicated on the assumption that we don't see a continued downdraft in the equity market and therefore tighter financial conditions, and that any economic weakness that we see to start 2025 is offset in Q2 and Q3 as the data normalizes. Also embedded in our concern is the notion that we are somewhat overdue for a spike in the unemployment rate during this cycle. A lot of Trump's initial actions in Washington have undermined confidence in the labor market, at least on the government side. The unknown is whether or not that translates through to state and local governments and potentially into the private sector. There's no question that there has been a shift in momentum in federal hiring. Apparently, long past are the days in which the government was a key contributor to payroll's growth. Now, even if the reshuffling of federal jobs doesn't ultimately pressure headline payrolls lower, it goes without saying that the sector will no longer be a growth business, as it were. This sets up a very interesting period for the macro narrative, if nothing else, and we'll look at the consumption data as a potential harbinger of downside. In January, the real personal spending figures fell 0.5%, and as we ready for February's retail sales numbers, the broader fallout of sentiment on the pace of consumption will come into focus. The week ahead also contains two auctions of note, the $13 billion 20-year, as well as the $18 billion 10-year tips on Thursday. We'll be watching the initial jobless claims figures, given the volatility that we have seen recently in the series, and of course the implications for the trajectory of the real economy and therefore rates. The wild card does remain the equity market, and any wholesale repricing toward a weaker risk asset environment would only serve to reinforce some of the recent bid that we have seen in the Treasury market. And if nothing else, it is consistent with our 10-year forecast for 2025, which has the benchmark ending this year at 4.0%. Keep in mind that our biggest call is that the 10-year sector is going to hold a range, and we'll argue that the market is actively in the process of defining that range. This is typical when monetary policymakers take a step back for the 10-year rate to trade in a range of 100 to 110 basis points, and we suspect that the upper bound of that range has already been defined and comes in at 480, which was seen in mid-January. The bigger unknown at the moment is defining the lower end of this trading range. It's not unreasonable to expect a three-handle at some point, but we do anticipate that such momentum would eventually stall out and rates drift back into the low 4% for the 10-year benchmark at least. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as we say farewell to the season, winter is leaving, we look forward to the equinox on Thursday morning. And no, not the gym, rather when the sun crosses the equator and shines equally on both the northern and the southern hemispheres. It's kind of like a dual mandate. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, We'd love to hear what you thought of today's episode, so please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.